Hello student, welcome back to Orator Academy. Today we are going to study our same chapter, that is the chapter number 8, Sources of Business Finances. We have already discussed Owners Fund. Now we are going to discuss Borrowed Funds. Borrowed funds refers to the money raised by the business through loans or borrowing from external sources. Unlike the owners fund, borrowed funds are available for a specific period and must be repaid according to the agreed terms and conditions. The borrower is also required to pay a fixed rate of interest irrespective of the whether the business earn profit or incur a loss. In many cases, the lender requires security in the form of business assets before granting the loan or finance. So borrowed fund is the amount of money that you borrow from a particular financial institutions, from a person, from any other institutions which are ready to pay you, but you have to pay a certain amount of interest or a fixed rate of interest on the borrowing amount as per the agreed terms and conditions specified by the particular institution or the person. So borrower is also required to pay a fixed rate of interest, which is a very much important from the borrower's point of view, because the borrower wants to pay a fixed rate of interest along with the principal amount, and the borrowers, whether he or she earning a profit or not, or whether they are incurring the profit or incurring the losses, in both the cases they have to pay the fixed rate of interest. So borrower fund is the basically the liabilities that you increase or that you bear once you take the loan from a particular institution or the particular companies. So in many cases, lender requires security in the form of business assets, because borrower funds definitely require you to keep a particular assets against the borrowed money, because it sometimes it should be equal to or should be of a higher value in case you are not capable of paying the same amount of money to the lender, and then the lenders can sell the assets and can recover his borrowed amount. So in that case, the lender is very much required to keep the security against the money they borrow to the particular person, and lender requires security in the form of business assets before granting the loans. So lender definitely ask the borrower to keep assets as a collateral, keep the any assets or any gold, sometime any other things which is of a higher value. They should keep them with themselves, and these kind of assets play a very important role once the lenders is ready to pay the particular amount of money in the form of loan to the borrower. So borrowers has to pay interest along with the principal amount, and once the borrowers complete his principal amount or say pay the interest, then the borrowers can recover his assets from the lender. So important source of borrowed funds might be in a different form. First is a trade credit, second is a factoring, third one is a lease financing, fourth one is a public deposit, fifth one is a commercial paper, then debenture, then commercial bank, and then financial institutions. So these are the major sources of finances in terms of money you borrow from these institutions or these particular sources. First is your trade credit. Trade credit is a credit extended by one business firms to another for the purchase of goods and the services. It enables the buyer to obtain the supply immediately and make payment at a later date according to the agreed credit terms. The term of credit or trade credit vary across the industries, and they're generally mentioned in the invoice. So this is a particularly trade credit, or it's basically you can understand through the business to business. One business firm provide goods and service on credit, or they do the business on credit, and say a 30 days, 45 days, or 90 days period is mentioned to repay the amount of the sold goods, because one business firm will sell goods on a credit to another firm will pay against the purchased goods in next 30 days, 45 days, or in 90 days. So this is the trade credit. So term of trade credit vary across industries and are generally mentioned on the invoice. Now, what are the merits of the trade credit? It is a convenient and a continuous source of finances. It is readily available when the buyers has a good credit worthiness. It helps seller promote their sales. It enables businesses to increase inventory in anticipation of the higher demand. It does not create any image on the assets of the business. So this is how your term of credit will be very beneficial for the companies. And one particular company is selling goods on a credit, and other is buying on the also on credit terms or credit note. Now we will understand what are the limitation or the demerits of the trade credit. First is easy availability may increase the over trading and increase the business risk. Sometimes you may continue supplying the goods on a credit basis, and sometimes it might be possible that the purchaser would not be able to pay the money on time, or pay the money for the goods they have purchased on time. So it will increase the business risk, or sometimes you incur the losses once you are not able to recover the amount of the sold goods. So you should be very careful about increasing or over trading. Second is only limited amount of finance can be obtained. You can obtain a limited amount of business, limited amount of trade credit, suppose 50,000, 60,000, or might be 1 lakh, but more than this you would not be able to get the goods, you would not be able to get the worth of the goods and services, because you have to pay a certain sum against the goods you have purchased. So this is the basically the credit terms or credit amount or a limited amount in terms of finance that you obtain. So one business will offer the finance or offer the money to another firm, and another firm will be able to get more amount of money if they are having their credit worthiness in the market or in the eyes of the particular lender or particular companies who is supplying the goods or service to the particular company or the person. It is generally a comparatively expensive source of finances, because normally you do not have to pay is interest rate against the trade credit, because trade credit is basically the goods you sold to the another firm or another customer, and this is on a purely on a credit basis, say 30 days, 90 days, or 45 days. But after 45 days or 30 days or 90 days you have to pay the amount of the purchased goods. So they are not charging any interest on the sold goods or the sold worth of sold goods sold the amount of money in the particular goods. They are just giving you the goods, and they are collecting the money after 30 days or 45 days, say 90 days. But you do not have to pay any interest amount on these sold goods or on these money of the sold goods. So you are generally doing a business which is of a very much expensive, and this might be expensive source of finances in terms of trade credit. Next factors we next point we are studying about the borrowed fund, that is a factoring. Factoring is a important terms in terms of finances. So factoring is a financial service under which a specialized institutions called a factors purchase a firm's book debt, say account receivables, or provide a immediate finances after deducting a discount. So the factor also undertake collection of a debt or may provide protection against the bad debts. So this kind of financial service or financial service, which is based on the factors payment or factors purchase, but this kind of factoring is very much particular for the account receivable, because the one firms will purchase another firm's account receivable or say debtor. Sometimes they provide immediate finance after deducting a discount. So this is a very particular factoring or a particular good source of finance for the business firm. So this chapter explains two types of factoring: recourse factoring and that is non-recourse factoring. Recourse factoring, the client bear the risk of bad debts, and the non-recourse factoring, that means the factors bear the entire credit risk. So besides financing, factors also provide information regarding the creditworthiness of a customer or may offer consultancy services. Sometime once you study about the factoring aspects of the business or a factoring aspects of a borrower fund, firms usually acquire the account receivable of a particular company in which the most of the debtors to whom the money is to be received. The company who take the account receivables of a particular company pay the amount to to the company to whom they have taken their account receivables, and against it they are also paying the amount of the all the accounts receivable to a particular company to whom they have taken their account receivables. It means that they are paying the due amount of account receivable to a particular company, and now this account receivable is the assets of the company to whom those who have paid the amount of account receivable to the particular company or the amount. So this factoring is a basically a business between the two firms in which one firm will pay out the account receivable to another firm. First firm who has paid the account receivables, now account receivable will be transferred to their account, and later on this particular company who has paid the amount to the second companies, now they have a right to recover the account receivables amount from the particular customer or the borrower or the person. But there is a risk of not collection of the particular amount from the customer, because the customer might be bankrupt, customer might be not able to, not in a capacity to repay the amount as per the account receivable. So this is the kind of factoring in which particular company who take the account receivable, they will deduct a certain amount. For example, account receivable of 1 lakh, and particular company is paying 95,000 to the companies of for the account receivable, and the rest of the 95,000 is paid to the company, and 1 lakh now they have to recover from the different customer to whom they have to they have sold a particular product or services by the first company. So factoring working in a particular direction in which two firms are working with each other, but one firm is paying a certain amount or charge a discount from the particular company, those who are having the account receivable, but the company who has paid the account receivable amount, now it will collect the amount from the market. So this is the factoring. So recourse factoring will in which the client bear the risk of bad debts, and non-recourse factoring in which the factors bear the entire credit risk. So in the first point, those who have taken the account receivables, they are liable to bear the risk of bad debts, right? Or in non-course factoring, factors bear the entire credit risk. Factors means the company who have taken the particular account receivables or account receivables amount or account, they are bear the credit risk, because there might be a chance that they would not be able to recover this particular amount from the particular customer. So two type of recourse factoring or non-recourse factoring will be there. Next, what is the merit of factoring? It is generally cheaper than the many other forms of short-term finances. Faster cash inflows enable timely payment of the liabilities. It ensures a regular flow of the funds from the credit sales. It does not create any charge on the business assets. And last, business can concentrate on its core activities as a bad debt collection is handled by the factors. So in the factoring, two firms, or say one firm is providing the finance to the other in terms of account receivables, and first firm will recover that account receivable from the particular customer or the client. So client, if client is bear the risk of bad debts, then it is considered as a recourse factoring. If the company who has paid the account receivable amount to the another company will bear the entire credit risk, there might be chance that they would not be able to recover the account receivables. So in this way you will understand the merit of factoring. Then you understand the limitations of factoring. First limitation is it may be costly when there are the numerous invoice of the small accounts. The advance provided often carries a higher effective cost than the normal borrowing. Third one is customer may not always be comfortable dealing with the third party. So this is all about the limitation of factoring. Next is lease financing. You will understand the lease financing also in this particular point. What do you mean by lease and how you would finance? Lease financing is a contractual agreement in which the owner of an assets allow the another party to use the assets for a specified period in return for a specific or a periodic lease rental. You can take the example of a shop owner who provide his shop on a rent to the tenant, and the in the particular terms in the lease financing, lessor is the owner of the assets and lessee is the party or the tenant who will pay the rent against the shop, who have hire purchase system, or the lessee who has taken the shop from the particular lessor on a rent. So once the owner of the assets, who is called a lessor, provide his shop to the lessee for use, against it lessee will pay a certain amount of rent, for example 5,000, 10,000 to the lessor. This is what called is a lease financing. So in a lease finance, a particular assets is given to the lessee for use, and against it lessee will give you the particular amount of rent. Ownership remain with the lessor. Ownership will not be changed. Ownership will remain with the lessor, while the lessee obtain only the right to use the assets. So at the end of the lease period, the assets is returned to the lessor. Lease finance is a commonly used for acquiring the assets such as a computer, electronic equipment that becomes obsolete quickly. So lease finance is basically used for the acquiring the assets such as a computer, electronic equipment that becomes obsolete quickly. So this kind of particular product or item will be more usable in terms of lease finance. Now, what are the merit of lease finances? It enables acquisition of assets with a lower initial investment. You do not have to put more money into investment. This particular assets you may acquire with a lesser initial investment. Second, require comparatively simple documentation. Just like a rent agreement, you can design in a favor of a lesser or lessee. Second, lease rentals are deductible while computing the taxable profit. During the taxable profit, or when you can calculate the taxable amount on your income, then you can deduct the lease rental, because under the section tax, under the income tax, or under section of the income tax, lease rentals are deductible. It does not dilute the ownership or the management control. It does not reduce the borrowing capacity of the business, and the risk of technology obsolescence is generally borne by the less. Once the computers who have been given on rent, or a lessee who have acquired the particular computer on a rent, if the particular computer or related technologies become obsolete, then this kind of obsolescence is a kind of a risk, and that is the risk is borne by the lessor, who is the owner of the asset. Next is your limitation of lease financing. Lease agreement may impose restriction on the use or the modification of the assets. Business operation may be affected if the lease is not renewed. Third one, premature termination may result in a higher financial obligation. And fourth one, lessee never become the owner of the assets and therefore does not enjoy its residual value. So these are the limitation of the lease financing, and the lease agreements is a very much important document in this particular lease financing. And these kind of lease agreements are done between the owner of the asset, that is the lessor, and the tenant, who might be considered as a lessee, and they both become the party of the particular agreement, and they share assets against the rent. So this is the particular lease financing. Next is your public deposit. Public deposits are the funds raised by the company by inviting the public to deposit their saving with the company for a specified period. The acceptance of a public deposit is regulated by the Reserve Bank of India. Now, if you are studying about the public deposit, and you deposit a particular amount, or a particular company raise a particular public deposit, then they are just raising the loan or some kind of money from the general public. And this kind of public deposit and its acceptance is regulated by the Reserve Bank of India. And what are the merits? Procedure is a simple and generally free from the restricted conditions. The cost is usually lower than the borrowing from the bank and the financial institutions. Public deposit generally do not create a charge on the company's asset. So here you have to pay, as a company you have to pay a very less amount of interest on these particular public deposit. Second, this kind of public deposit do not have any collateral assets of of the company who has borrowed this particular amount. So public deposit will not be backed by any further securities that is put by the particular companies or its assets. Since depositors do not have a voting right, managerial control remains unaffected. So, number of people who have deposited certain amount of money, or the company who have raised a certain amount of money from the particular depositor, they do not become the owner of the company, or they do not have a voting right. So they would not be able to dilute the control of the management. So public deposit is just kind of money or the fund raised by the companies by inviting the public to deposit their saving with the company for a specific period. But against it, they just have to pay a minimum amount of charge, and these charges are very much less, or less in terms of interest. Now you understanding the next point, limitation of public deposit. New company often find it difficult to raise funds through the public deposit. It is an uncertain source because public response may vary. Sometimes people might not be interested to deposit their money with the companies, because companies are not paying a huge amount or a good amount of interest on these public deposits. Mobilize a large deposit can be difficult. You cannot channelize, or you cannot shift that particular large deposit from one company to another. You cannot mobilize these funds into different ways in terms of production or consumption, or sometime purchasing of the different assets. So these kind of mobilize of the assets is not possible. Next is your commercial paper. Commercial papers is an unsecured money market instrument issued in the form of a promissory note, and it was introduced to provide the highly rated companies with an additional sources of short-term finance and is to diversify their borrowing options. Commercial paper is basically unsecured money market instrument, right? So in because this kind of instrument is issued in form of a promissory note. You have heard about the promissory note in that particular. So you have heard about the promissory note in a particular case. Now, this promissory note is just like once you buy, once the particular company or say two companies buy goods from each other, and they write or they promise to pay that amount against the goods on a certain period of time. So this kind of working is called a commercial paper, in which the one company is obliged to pay a certain amount of money to another companies and against the goods and service they have received from the first company. So it was introduced to provide a highly rated companies with an additional source of short-term finances and to diversify their borrowing option. So commercial paper may be issued for a period ranging from 7 days to 1 year, but it will be between the two companies or the two money market segment. Let me help you to understand its merit and demerits. First, merit: it is unsecured and free from the restricted condition. It is easily transferable and therefore highly liquid. It is generally provide finances at a lower cost than the commercial bank loans. It offers a continuous source of short-term finances because fresh CPs can be issued when earlier ones mature. So this is a particular case in which you will only obliged to pay a certain amount of money, and then in the second time you would be able to get the further goods and on credit. Then you can pay the that credit amount on a later on as per the terms and condition of the particular companies. So it generally provides finance at a lower cost than the commercial bank loan. It offers a continuous source of short-term finances because fresh CPs can be issued once earlier one mature. It means that once you pay the earlier amount of money of the goods and services to the companies to whom you have purchased particular goods and service, you have paid that amount, then you can raise your second source short-term finance against the newly buying good newly bought goods from the particular companies. And the companies with the surplus funds may invest in a commercial paper or earn the returns. Sometimes the companies who are busy in having a who are busy in supplying the funds in such form of commercial papers, and they earn the more profit in terms of revenue. So these are the merit of commercial paper. Now you will understand the limitation of the commercial paper. Only financial sound and the highly rated companies can issue the commercial paper. The amount that can be raised depend upon the availability of surplus fund with the investor. It is an personal, yeah, impersonal source of finances. Its maturity cannot be orderly extended if the issuer face financial difficulties. So these are the quite important limitation of the commercial paper. Next is your debenture. A debenture is an instrument through which companies acknowledge a debt borrowed from the public. It represents the loan capital of the companies, and the holder of the debentures are regarded as its creditor. Unlike the shareholder, debenture holder do not have a voting ownership right in the companies. They receive interest at a predetermined rate, irrespective of the company's profit or the losses. Debentures are generally issued under the company's seal of the under the common seal of the companies and are redeemed after a specified period. So these are some of the important points that you can understand. Debenture holder do not have a voting right, first of all. Second, they will definitely have in charge or definitely receive a fixed rate of interest. Then they do not have the right to cast a vote in the general meeting. So these are the some of the important obligation which are borne by the or borne by the particular debenture holder, but they have certain merit. First merit is they will earn a certain rate of interest or a fixed rate of interest. Company pay interest rate at a predetermined rate, making the cost of finances predictable. They would no dilution of control because the debenture holder do not have the voting rights, so they could not change or control the managerial aspects of the business or the company. The debenture holders are creditors and normally do not have the or possess the voting right. So therefore, issuing debenture do not reduce the control of existing shareholder. Definitely, they have a tax benefit. Interest paid on the debenture is treated as a business expense and is deductible while computing the taxable income, thereby reducing the tax burden of the company. If the company has taken debentures or raise the loan amount by issuing the debenture, then they are able to pay the interest on these particular debenture or the raised amount through the debenture. But these kind of interests that they have paid on the debentures and or the amount they have raised through this particular sources of income or sources of finance, these particular interest is deductible once they calculate their taxable income. So once the companies deduct the interest out of the particular revenue, they would definitely have a very less amount of revenue or the profit, and upon which they do not have to pay a income tax or the very huge rate of tax on this particular income. So this is very common and important source of finance for the business and firm. Next, suitable during the stable earning. Debentures are considered appropriate once the company's sales and earnings are relatively stable because the fixed interest obligations can be met comfortably. So in this particular point, if the company is earning a suitable amount of revenue, then they can raise the funds from this particular source of finance. Otherwise, they do not have to do this. Next is your limitation of debenture. For the company's point of view, they do have to pay fixed financial interest rates or the fixed interest on this particular debenture. Then that's why they are having a fixed financial obligation. Second, charge on the assets. If the particular debenture has been secured against the assets the company need to keep to raise the fund, then this particular debenture or its amount would be paid. If the company is not able to pay its debenture amount, then the assets would be sold out and the debenture money should be paid. So secure debenture create a charge on the company assets, restricting its liability to obtain the further secured borrowing. Next time, they would not be able to get another amount of loan against the debenture they issue to the general public, because the second borrowing would not be possible for the company because they have already kept a particular assets against it, or they have charged a particular company's assets against the amount raised in form of debenture. Next is repayment responsibility. Principal amount has to be repaid on a maturity, creating a future financial commitment for the company. So company have a repayment responsibility to pay their finance, to pay their interest, to pay their loan to the debenture holder. Next is commercial bank. Commercial bank you have heard about, just like a HDFC, SBI. You can take the loan from these particular companies and you can run your business. So this is a very common kind of sources of finance which you have heard and which you have understood many times. So right now I am skipping, but you can understand it's a merit and demerits. in as a form of sources of finance. Next is your financial institution. Central and state governments have established several financial institutions to provide the financial assistance to the business enterprises. These institutions are also known as the development banks. Many provide long-term finances for industry development. So we are talking about the particular development bank who will pay the money, who will serve the society, who will pay the loan amount as a form of sources of finances. So they are particularly suitable when the business requires sustainable funds for the expansion, reorganization, and modernization. Besides providing the finances, many of these financial institutions also offer financial, managerial, or a technical assistance, guidance to the business organizations. The financial institutions like the NABARD, who provide the particular loan for the agriculture and the development. So these kind of development banks, they provide a loan or a long-term finance to the business organizations, and these kind of business organizations has to pay a certain amount of principal amount and the interest amount thereon a regular basis. Now we understand the merit of the financial institutions. Long-term finances. Financial institutions provide a long-term fund for the major business requirements. Second is advisory services. In addition to the finances, these financial institutions, they offer the financial manager or technical advice to the business enterprises. Next, you are working on improve the goodwill. Receiving the finances from the recognized financial institutions enhance the credibilities of the borrowing companies, making it easier to raise finances or funds from other sources. So, if any companies who have been recognized or having a good credibility or credit worthiness in the particular market, they would be able to get more finances on more credibility or more goodwill. So raising finances from the recognized financial institutions enhance the credibility of the borrowing firms and making easier to raise funds from the other sources. Fourth one is convenient repayment. Loans are generally repaid in a easily installment, reducing the financial burden on the enterprises. Fifth one is availability during the difficult period. Financial institution may continue to provide funds even during the period when the other sources of finances are not readily available, because these kind of development banks are purely designed to pay more funds or more loan to the particular business or the number of business who wants to develop or expand their operation. So they would be able to serve the society, serve the business and the companies in during their difficult period or difficult time. Next is limitation of the financial institution. Lengthy procedures. Financial institutions follow the strict lending criteria and require completion of the uh, numerous formalities, making the process time consuming and costly. It means that you would not be able to easily get the finance from these financial institution or development bank. You have to wait for at least 2 to 3 months because their process is a time consuming and a costly. You have to wait or you have to complete the numerous formality related with the finance that you want to acquire. Next is your restrictive conditions. Borrowing companies may have to comply with the condition imposed by the financial institutions, such as a restriction on the dividend payment. These kind of companies who are borrowing from the financial institution, they would not be able to provide dividend or they would not be able to pay the dividend to their shareholder because these financial institutions will pay restrictions on or they put a restrictive conditions before they release or before they finance to the particular companies, because the company would not be able to provide the dividend to their shareholders. So this kind of restrictive condition is imposed by the financial institution on the borrowing company. Third one is nominee director. Financial institutions may appoint their representatives to the board of directors of the borrowing company, therefore limiting the company's managerial freedom. So this is the nominee directors. Next is international financing. We have already concluded our financial institutions and the borrowed funds from where you can raise your sources of finances or raise your finance. Next is your international financing. Internationally, you will also able to get the payment from the other companies or other banks on an international basis or the overseas bank. With increasing globalization and opening of the companies, Indian companies are also obtaining finance from the international sources. These sources help organizations raise funds in a global capital market for their business activities. The major international sources of finance discussed in these chapters are commercial bank or international agencies and development bank and international capital market. We have already discussed some of the commercial bank. Commercial banks are not working in India; they are also working in abroad. So you can take the loan from the commercial banks in the overseas market. These commercial banks operate internationally, provide foreign currency loan to the business organization. They are on an important source of finance for the international business operation. The type of loans and banking services differ from one country to another. Second, your international agencies and development bank. Various international agencies and the development banks provide medium-term and long-term loans and grants for promoting the trade, business, and economic development. Some important institutions mentioned in these chapters are International Financial Corporation, we call it the IFC, Export Import Banks, and Asian Development Bank. So these are the international agency and development banks who are usually provide medium terms and long term loans and a grant for promoting the trade, business, and economic development. Next is your international capital market. These are the some of the important uh, point that will help you to collect the money in the overseas market. First is your global depository receipt. GDR are negotiable financial instrument issued by the depository banks against the share of the companies. In India, they are issued by the Indian company in the foreign countries to raise the funds in the foreign currencies or are listed on the foreign stock exchange. So these kind of GDR is issued to the companies who have uh, listed their shares in the foreign stock exchange, and GDR is kind of a negotiable financial instrument that is issued to the particular companies who have listed their share in the international foreign stock exchange, and these stock exchanges are particular sources of finances for the particular companies. So holder of the GDR are entitled to benefit such as a dividend and capital appreciation and may convert the receipt into a corresponding number of shares. So GDR is a global deposit receipt which allows internationally to recover your money or get the money from the particular depository banks if they have is stocked or if they have listed their shares in the foreign stock exchange. Second is your American depository receipt. ADR are depository receipts and issued in the United States, and they are traded on the American Stock Exchange and are available only to the investor in the USA. Although similar to the GDR and ADR, are specifically meant for American security market. This particular American deposit receipt is applicable in the American stock security market as well. Next is your Indian depository receipt. We consider them as a IDR. IDR are the financial instruments and denomination in Indian rupees and issued by the Indian depository on the behalf of foreign company to raise funds from the Indian investor. So this is a particular IDR in which the particular financial instrument denominated in Indian rupees and issued by the Indian depository on the behalf of foreign company to raise funds from the Indian investor. So those Indian investor wants to make investment in the foreign companies, then Indian depository collect the money on the behalf of these foreign companies and they issue the idea Indian deposit receipt to the Indian investor. Indian investors have invested certain amount of money, and these idea is a proof of the same. So investors holding the idea receive the benefit associated with the underlying shares, or such as a dividend or the bonus shares, because Indian investors have made investment in the foreign companies or countries, so they are liable to get the some of the shares. Sometime they would be able to get the dividends, sometime they would be able to get the bonus share or the bonus issues against the main investment. Next is your foreign currencies convertible bonds. We consider them as a FCCB. FCCB are the debt securities issued in foreign currencies that carry a fixed rate of interest and provide the holders with an option to convert the bonds into equity shares or deposit receipts after a specified period. These bonds are listed or traded on the foreign stock exchange and resembles convertible debenture issued in India. So these are all kind of financial institutions which allows the companies to get the finance against their security, or sometimes the interest they charge from the particular company or the borrower. Next, we are studying what are the factors that will affect the choice of sources of fund. So, which source of fund you will choose, and how they will be affected by various factors. So, first factor is your cost. Business should consider both the cost of obtaining funds and the cost of using those funds before selecting a source of finances. So if you want to raise money from any of the sources of finances mentioned above, you must consider 2 points. What is the cost of obtaining that funds? It means that what amount of interest you will pay to obtain that particular fund, and if you are using that particular fund, what cost you will pay for the same. So cost of opening fund and a cost of using those funds before selecting a source of finance. So at one point you will consider cost, and at another point you will consider the revenue that you will generate by using that particular fund. So you will have to consider if the interest rate is higher than the revenue that you earn from that particular source of finance, then definitely you will avoid taking the money or taking the loan in form of finances, or choose a particular sources of finance if they are having a more cost than the revenue. You would avoid this. So you should only focus on those sources of finance which are having a less cost or less interest obligation against the revenue they receive from the particular uh, or the revenue they generate from the particular business. Second is the financial strength and stability of the operation. Financial position and the earning capacity of the business influence its ability to repay borrowed fund and the interest. Enterprises with unstable earnings should be cautious while using the sources involving the fixed financial commitment. If the particular company has a financial sound, or has a strength in which they would be able to make financial obligation on time, then they should continue taking the more finances, or they can continue to take the more money on the behalf of their business. So if they are financially sound, if they are stable in their operation, they would be able to generate more finances. Otherwise, they should avoid it. Third one is form of organization and legal status. Legal form of the business and determine the source from which the finance can be raised. For example, only joint stock companies can issue equity shares. So a particular company and its form or its legal status will allow itself to choose which source of finance would be applicable for this particular company. Next is your purpose and the time period. Sources of finance should match the purpose and the duration of the financial requirement. Short-term needs should generally be financed to the short-term sources, while the long-term requirement should be met through the long-term sources. Next is your risk profile. Each source of finance involve a different level of risk. Business should evaluate the risk associated with each source before making a decision. If you choose any source, then you need to analyze the risk associated with it, and then you can make the decision. Next is your control. Choice of finance should consider its effect on the ownership and the control of the business. Certain sources, such as equity shares, may reduce existing owners' control over the management. So, any firm, any organization should choose the financial model or should choose the source of finance in which they are not able to dilute their ownership, dilute their control of business in the hand of particular investor or the shareholder. If you are using the equity shares, definitely you will reduce the con- uh, existing control in over the management, or it will definitely you are giving the steering to the shareholder who will drive the companies in a who may drive the companies in the wrong direction. So you should be very careful before choosing a source of finance which might affect the managerial control and its business operation. Next is your effect on credit worthiness. The use of the particular source of finance may influence the company's credit standings and its ability to obtain the further funds in the future. If the company has its credit worthiness, then it definitely able to generate the finance from any sources. But sources of finance may influence the company's credit standing and its ability to obtain further funds in the near future. If the company have already taken the certain amount of funds or the loan from a particular period, it might affect its next lending on the basis of its credit worthiness, or the credit worthiness would depend upon the paying capacity or interest paying capacity of the business who have taken the loan earlier and want more loan for the future operation. Next is your flexibility and the ease. The ease of obtaining the finance and the flexibility of its term should also be considered while selecting the suitable sources of funds. It's you should consider its flexibility and ease of each of the sources of finance, then should work on this. Next is your tax benefit. Different sources of finance provide different tax advantages. For example, interest paid on the loans and the debenture are is generally tax deductible, whereas dividend paid on shares are not. So if you are getting the tax benefit on the loans or the debenture and they are tax deductible, it means that if the certain amount of tax is deductible out of the revenue generated by using this particular loan or debenture, then you definitely get a more benefit. But if you are raise the particular source of finance by issuing a particular equity share or preference share, and against it you have to pay the dividend, then definitely these pay out the dividend is not tax deductible, so you would not be have any tax benefit. So you should consider the loan or debenture who will provide you tax benefit, and then you can choose that particular sources of finance for your business and its smooth operation. So these are the factors of sources of finance, and these factors will help you to choose which source of finance would be applicable for you, and you, your choice would be affected by these factor of or sources of funds. So far we have completed our this chapter. Thank you for listening this particular lesson. If you like, then you can subscribe and you can share this particular video to others or other students. These particular videos are not applicable to only CBSE or RBS students. They are also applicable for the competitive exam, because in most of the papers you will have a banking exams. In the banking exam, you definitely have this kind of information. Then definitely this particular video will be helpful for you. So you can choose this. You can design your notes as per the specification. So now I'm concluding this particular video, and you can study this through this particular video, and you can make your own notes. In the next video, we will continue our next chapter. Till then, you can study and enjoy this particular video. Till then, thank you and have a nice day.